tonight we are going to take a look at some chart patterns. And I think what you will find pretty quickly is that a lot of them are interrelated. So when you were talking, when you were seeing Scott talk about the pole, is that a flag, is it a pole? A lot of those moves are very similar, and especially when they serve the same function, they tend to have a lot of similarity in their shape. So, you know, it makes sense. You think about a pole as a continuation and a flag as a continuation. There's going to be a lot of similar elements in them because the sentiment that's going on that's creating those patterns is very similar. So it makes sense that if the sentiment is similar, that what we'd see on the charts is fairly similar as well. So we are going to take a look at 5 of the most common patterns that we see in crypto. What you're looking at right now is the cover of a book called Technical Analysis. It's in our training as one of the recommended reading books. It's by Charles Kirkpatrick and Julie Dahlquist. A lot of times in the library you'll find it under Kirkpatrick. And the first pattern we want to talk about today, I'm going to go page 358 in the PDF document. It's actually 329 in the book. And I scroll down here and we see flags and pennants. So you may have heard of a pennant pattern, very similar to a flag pattern. And we're just going to kind of talk about it a little bit, and then we're going to go take a look at some examples. So it says, for efficient use of trading capital, consider trading with flags and pennants. They are frequent formations with extremely rapid and relatively reliable outcomes. After a breakout in either direction or either pattern, prices usually run immediately, having very few pullbacks or throwbacks and low rates of failure. So that immediate run is what we refer to as the flag pole. Not to be confused with the pole pattern, but if you look down here on the pictures of a flag pattern, you've got a flag pole leading up to the pattern. The up move becomes exhausted. We find some support, some buying. We meet resistance, buying, and then after we've kind of created this little channel that's running kind of opposite to what the general trend is, and you'll even see here A, B, C, that's what Scott's talking about, boom, we take off. Pennant is the same thing. The difference is that the boundaries are skewed together and they're not running parallel. So in a flag, we tend to see the upper and lower boundaries running parallel. In a pennant, they cross and form almost a triangle. But again, the sentiment is the same. So it says both flags and pennants are preceded by a steep, sharp price trend, best at 45 degrees rather than straight up. Crypto can be straight up. Keep in mind this book is from more traditional assets and regarding to what types of patterns we're looking at. And some of these things that they say in here, crypto kind of bends or breaks the rules. So Guy says, learn the 4 reversal patterns: head and shoulders, inverse head and shoulders, falling wedge, rising wedge. The rest are continuation patterns. Yeah, so we're going to take a look at head and shoulders, and I kind of just lump inverse as a head and shoulders pattern. And we're going to look at triangles, double tops and bottoms, head and shoulders, poles, and right now we're looking at flags. I didn't put wedges in here only because wedges I could almost do an entire night alone on. Because we see them a lot in crypto. They're all over the charts. So maybe that could be a really good lesson we could do. So I'm going to continue on with flags. So it says 2 parallel trend lines in a small channel that resembles a flag form the pattern, and the slope of the channel can be in any direction, but most commonly the best performance comes when it slopes away from the preceding trend. So you see here's the trend, slopes away, trend. So I'm not going to go into too much detail with these. He goes on to talk about measuring them, gives a little more detail. But we're going to come over here and take a look at something else I've got prepared here. And we're going to go over here and look at some flag patterns. And when we get to the end of this, I will post the link, and you guys can review this later. And if you do choose to review it, know that when you're navigating one of these Prezi presentations, all you have to do is click on what you want to see. And so here you see flag patterns. They can be bearish or bullish. They're continuation patterns. They need a pole going into and out of the flag to be a true flag pattern, and we see them on all time frames. And these pictures, you can also click on them as well. So here's an example of a bullish flag. Here's an example of a bearish flag. Only difference is the approaching and exiting direction is either up for bullish or down for bearish. And you'll notice what I was talking about earlier. We really want to see a flagpole followed by a flag shape, and then a breakout of another pole heading out. And a lot of times this pole is part of a breakout in itself. So if we see a reversal or some kind of a pole pattern, we break out, that can form the flag pole of an incoming flag pattern. So you start to see how these are all really connected and really, you know, they're all part of the pattern together. Here's another example of the flag and the pennant. That was straight out of the book. We saw that. And then here's an example I pulled up to find on the charts themselves. So you see Bitcoin, a 60-minute chart. This was back in February. This is a local time frame chart. You see we fell down price here. We kind of made a pole down here that didn't work. So a lot of times poles are continuations, but sometimes they don't work, and we see that a lot in crypto. We broke out of this pole to the upside. Here's a nice pole formed from the break. Maybe, and now that I'm looking at this with it zoomed in, because I had a different format on training view, you could even argue that this right here is kind of a wedge pattern, right? Which is like also a reversal pattern. That's what Guy was talking about. So some of you probably, now that I'm looking at it on this picture, would see a wedge here. And so we reverse out of that wedge, or we break out of the pole, depending on what you see. We form a bit of a pullback as this buying gets exhausted. We go sideways, but down at it with a slight angle, and then boom, we break back out of the top of that pattern, strong buying, and the flag is complete. Okay, so that's our flag patterns. I'm going to back out of this, and we're going to go back to our technical analysis book, and we're going to take a look on page 343 of the PDF and talk about triangles. So they are, I almost debated not putting triangles in like I did with wedges, because triangles have several types themselves. And you'll see in bold here in the text, you'll see descending triangle, ascending triangle, symmetric triangle. And then they'll say when both the upper bound and lower bound are slanting, it's called a wedge. So really, wedges being a part of triangles, but so many variations of wedges. You really have to realize that when you are starting out as a new trader and you are trying to make sense of all these patterns, one of the best things you can do is start looking at all these different pictures and going through the charts and really trying to identify pictures that match up. Okay, so I want to talk about a descending triangle first. So a descending triangle with a breakout down. So here's a descending triangle with a breakout down. We entered from the bottom. We met resistance. Support is flat across the board. The highs get lower, forming a downtrend line. And finally, the support breaks down with a breakout, a hook or a pullback, and then the go. So that's a descending triangle. The typical pattern, sorry, let me back up a second, because this is a breaking down descending triangle. You can also get a descending triangle with a breakout up. So when we talk about descending, what we're talking about is the top of the triangle slopes downwards. It's not the price action, because here's another descending triangle, but we break to the upside. So I know a lot of people when they're starting out get that. Why is it called descending, ascending? You'll see with the ascending triangle, it slopes upwards. You can break out to the downside, or you can break out to the upside. And then we have a symmetrical triangle, which slopes on both sides of the triangle. I see these all over the charts in crypto. And so if I scroll back up here at the beginning of this section, because I just kind of wanted to look at them first. In this textbook on page 315, he's got statistics on triangles, the different types of triangles, the performance from this sampling they took, the average performance, their tendency to retrace, and how often they reach the target price. Notice that descending triangles with a break up significantly outperform in terms of reaching the target price compared to many of these other versions of triangles. Now, it's important to know that to really get statistics on patterns, you have to go out and pull measurements, and you have to go out and analyze them, or get a computer program to do it. And crypto is going to be slightly different. Guy says triangles break about 70% bearish. Yeah, and that may be true. And it's hard for me to agree or disagree with that. I do say that I see them break bearish a lot, but I haven't measured them exactly. So I have a hard time putting a number on crypto patterns themselves. But there are a ton of statistics on traditional asset markets, and it helps just to see kind of how often they're successful in traditional markets, because when people are going back and researching them for crypto, they're going to be paying attention to the same numbers, right? So I'm going to switch back over, and we're going to take a look at our triangle patterns. They can be ascending or descending. We talked about that. They can result in a continuation or a reversal, depending on the context. Now, keeping in mind that wedges, being a type of triangles, tend to be reversals. But the breakout versus the entry is what makes it a continuation or a reversal, and it could be either. Continuations usually require a break, hook, and go to confirm them. And then we often include false breakouts to the up and downside. We see so much in crypto, head fakes, fakes to the downside in triangle patterns. And what you want to look for really is volume to increase on a breakout. So here's a nice simplified version of, you see the ascending triangle here, because the slope is up, breaks to the upside. You see the descending triangle, break to the downside, and you see a symmetrical, which breaks to the upside. And now here's a little bit more informative version. So there's a breakdown here of what really makes the shape. I'm not going to read through all of this. You guys can go back and play it back if you want to read them. You can probably find it on a Google image search. But that's basically a quick little summary of what I just explained verbally. And then here you can see a look at Bitcoin on the 240 chart. Here was our mid-December lows. We entered in from the bottom. We start to form an ascending line here, and we see a breakout to the top. Now notice on the 240, there's a breakout, no hook. It just takes off and goes. If I zoom in, there's a little bit of one, but crypto sometimes will not give you that hook if it's a significant strong break. And you look down here at the volume, there's the volume on the breakout. And a lot of traditional breakout traders, they would have either a limit buy, or they'd be waiting right on the other side of here for the breakout to buy with a stop somewhere down inside, or even better, below this ascending trend line in this triangle pattern. And notice here, it's not perfect. And if I had drawn this line out really straight, it would have made the shape not work so well. So you really have to kind of see how they touch. And some people could argue, even if they drew their line here, that it might be kind of a pull. But I really see this as a ascending triangle, and it enters from the upside, breaks back up to the upside. So a reversal on a low time frame. Okay. I'm still getting used to switching back and forth with the share feature, so bear with me. I got to escape here. There we go. Awesome. Now we are going to take a look at double tops and bottoms. And a double top and a double bottom formation is about the simplest of the classic formations. A double top consists of only 3 reversal points, 2 peaks separated by a trough. For it to be a true double top, the initial price must enter the pattern from below, and the exit signal must occur on the breakout below that trough low. So we'll look at that in a second. And traditionally, the 2 peaks must be at or within 5% of each other's price level. And then they even say the middle valley should be around 10%. Now, crypto, again, infant market, sloppy. You see double tops and double bottoms that you could sit there and all day long pick. Is it not? Suffices to say that you're looking for something that pretty clearly indicates a strong resistance or a strong support, if we're talking about the other. And it has one dip or one bump counter to the other 2 pivots. So we see pivot 1, pivot 2, pivot 3, and then we break out past that second pivot point. We break out, we hook, and we go. That's a classic double top pattern. And one of the things that they mention here is the failure rates are 11%. This means the odds of making a profit from a double top downward breakout are minimally risky. Bulkowski ranks the overall performance rank at 2 out of 21, a very high ranking. So they actually ranked patterns based on their failure rate, their average profit, and the percent of trades reaching a price target. And so double bottoms traditionally and double tops traditionally are very reliable in terms of when they have formed properly and they show a breakout, there's a pretty good chance they're going to quickly move to where you expect them to go. Not always, but pretty easy, pretty commonly. So if we look at this double top, double bottom here, it is a type of reversal pattern. You should wait for the breakout to occur for confirmation. There's 3 major pivot points, top, bottom, or bottom, top, bottom. And 64% of them fail to penetrate the breakout point and end up becoming a continuation move. So that 11% before is if they break out and confirm. But this is why it's so important to wait for the break hook and go. Because if you try to enter into one of these patterns before they've confirmed, you're going to have a bad time 64% of the time. So that's why we wait for confirmation. You can see here a little look at a double top and a double bottom pattern. So this pattern here is part of, you see an ascending triangle there, and it hits the first peak, bounces off the reaction low, hits the second peak. Here they show a high risk entry because, again, 64% of them fail to break out, so it's very risky. But once it breaks out and backs up and confirms, you've got your conservative entry. So that would be for a short, for a double top. By contrast, you can see over here with the double bottom, comes in from the top, bounces, hits the reaction high, bounces. Here's your high risk entry because 64% fail. But once it breaks and hooks, you've got a conservative entry. You would want your stop. Best place would be somewhere below the bottoms themselves. Some people with very tight constraints might put it somewhere up in here. But if you really want to scale in smartly, and you will learn more about that if you become a full commandments trainee, if you're only a foundations or a bubble subscriber, scaling in and out is so critical to long-term consistent profits, and it's tends to be done on the conservative entries more often than not. So that's the double top and bottom. Back up here, and we'll switch back over. I'm going to go real quick. We've got rectangles and head and shoulders left. So we're going to first, I know I've got the rectangles up there, but I really wanted to look at the head and shoulders first, and I'm going to speed it up because I know Scott's coming back soon. So we got head and shoulders. So the head and shoulders pattern is probably the most famous technical pattern. Most of us have heard of it. Its name is often used when ridiculing technical analysis. Yet its profitability is very high relative to other patterns. It's one of the few that the study that's mentioned in here showed had statistical significance. It's a complex pattern because it combines all 3 potential characteristics: trend lines, support and resistance lines, and rounding. It's most often seen at a top or bottom, but it can occur in its normal state or as a failed formation in a consolidation. In crypto, we see that all the time. Here's the key. Mostly, it should be traded only after it has formed completely. Okay, so here's your traditional head and shoulders pattern. We see this all over Bitcoin because Bitcoin likes to do 5 Elliott waves and then do a reversal with the head and shoulders, or an inverse head and shoulders. You see the neckline is where your 2 supports are formed after we get the shoulder. We get a support, head, same general support. Then the shoulder, we break that support, we pull back to touch it, and that's when a lot of the sellers, the more conservative sellers, will enter heavy back to the downside. So there's more I could read, but I want to keep it moving because I know I'm taking up a lot of time myself. So let's just take a look at what I've got gathered here. So head and shoulders can be standard or inverted. They are reversal patterns. The context must be taken into account. True head and shoulders patterns appear at the end of a wave cycle or an important support and resistance level. And they can and will fail in crypto, often during consolidations, as mentioned by Kirkpatrick. So you should be used to make sense of the chart. Sorry, I worded that wrong. The head and shoulders itself should be used to make sense of the chart, but not solely to plan trades. Maybe you scale in a little bit of an entry after one is completely formed, but you don't want to plan a trade around them because they will fail, especially in crypto. So here's a basic setup where you see where they even show if you're going to be real aggressive and not wait for the pullback, you could enter with a stop loss above the shoulder. For a short, it'd be the same way inverted, but the real conservative entry is going to be after you get the break hook and go. Here's I inverted that same image so you can see what it looks like with an inverse head and shoulders. This would potentially be your first stop, your first entry, and then your second buy would be down here after they make the second, and you'd pull your stop up if it's confirmed. Again, that's a little more advanced. Here's what it looks like with candlesticks. It gets a little sloppier when it's not just a pretty line, but you see a shoulder, you see some strong selling, a head, some strong selling, and the right shoulder. Here's that huge bearish engulfing confirmation. This pattern is probably going to go down. And then for our lovely example from Bitcoin at the top of 2017, you see a left shoulder. We come back in and we check in with this neckline. We go back up pretty quickly to form a head. Look at this heavy selling that comes in. I circled. You can really see the selling come in on the backside of these triangles, and what that is that's them the big boys are getting out of their positions. They're selling their first bit, letting the price come back up, selling the majority of their position. That's where the heaviest selling comes in, letting the price come back up, and then selling and exiting the rest of their positions, and really driving the break of that neckline. That's going to signal to all the other momentum traders, okay, we've broken it. Here it comes back in. Now you all can start to enter. We've confirmed it. We're going down. So nice head and shoulders at the very top. And then I hear Scott's coming, so let me real quick.
You keep going. You're fine.
Because I could talk about, there's so much to go into with these patterns.
Teachers in the house.
And then the last one we'll talk about, most commonly referred to as a rectangle, but you'll hear Scott call it a pole. The pole trade, the box trade, the money box. Mike spitting fire like Charmander. Thanks, Nova. That little Pokemon reference. So it's one of the simplest of patterns, consisting of a resistance line above and a support line below. Each resistance or support line must also be a trend line, which means that it must touch roughly the same price reversal at least twice. So they want to see at least 2 touches before they call it a rectangle or a pole. So you see in here, we come up, we hit resistance, support, same support, same resistance. We don't quite get back down to the same support, but we break that resistance that was established 3 times. The pole has been formed, it's been broken, hook back. That ceiling becomes the crypto floor, and we go.
It's like the dollar.
Just like the dollar. And they even mention in here false and premature breakouts because, as you'll see a lot in crypto, breakouts are not exits from a formation, but are minor breakouts above or below, and they quickly return into the formation. They can occur at support and resistance levels. It's a false breakout. We call them head fakes. We see them all the time.
It's where they run out of, if they're going up, they run out of buyers and they have to come back down. If they're going down, they run out of sellers and they have to go back up. And basically, that's where I talk about you go up to go down and go down to go up. You have to go find the sellers or the buyers.
Exactly. And so whether you call it a rectangle or a pole, and the big scope, it can be called a range. It's a type of consolidation. It's usually a continuation pattern, but in crypto, you can get poles that don't work. They happen all the time. That's why you want to wait for a break hook and go to confirm that continuation or reversal out of the pole. And similar to a flag in its function, but it's flatter and it doesn't always have a pole. Here's a really good look at a pole going to the downside as a continuation, break hook and go.
XRP right now. XRP.
This is yes, totally.
XRP USD right now.
He said, we're going to go down. Just kidding. And all the Moon Boys said, well, we're recovering, guys. Look, buy it now before it goes back. No.
The 12 cents.
Goodbye. And then here's the poll going up. And the last one I'll leave you with before I hand it back to Scott. Here's a nice little example. This whole area you could argue was a poll because they were just getting ridiculous before they broke that 6K support on Bitcoin. This is back after the all-time high coming down.
You can see them clearing you can see them clearing the orders too back in the back. They cleared the orders early when they broke down all the way in the back.
Yep.
As they pierce, whenever they're piercing, they're just going down there clearing orders.
right here. They're getting them cleared out.
They're taking in the
them
buy
out here.
orders. They're
Yep.
taking in the buy orders.
Letting them come in because they know they're going to go lower. They might even let them have a good time for a little bit.
Yep.
Trust me, they've got this in mind all the way back here. So they enter the pole from the upside. We see the resistance 1, 2. We hit the support. We're not sure exactly.
Great alt trading right there before we went off. There was some great alt trading right there before we went off the cliff.
And that's one of the last things I was going to mention is when you see Bitcoin in a pole, it's almost always the best times we get for alt trading, because when Bitcoin is relaxing and fairly stable in sideways movement, that's when they're over playing around inside the market and a market on the alts. So that covers 5 of the most common patterns we see in crypto.